Hi, good morning, and welcome everyone to Merchants Bonding Company's live webinar offering for the course Commercial Surety, License and Permit, and Public Official Bonds. Now that we've gone over the requirements to receive the 2 hours of continuing education credit, let's go ahead and dive in. So again, welcome. I'm Robin Shepard. I'm a senior commercial underwriter for Merchants Bonding Company. I've been with Merchants for about 6 years, and I handle Indiana, Kentucky, Kansas, and Missouri. Prior to joining Merchants, I did work at an MGA for about 13 years where I handled commercial and contract surety as well as property and casualty insurance for small businesses. Thank you. Nick?
And I'm Nick Warner. I'm a commercial underwriter with Merchants Bonding Company. I've been with the company about 7 years now, and I handle commercial business across Texas, Arkansas, Oklahoma, and a number of other states here in the South. So today, Robin and I will be presenting the course Commercial Surety, License and Permit, and Public Official Bonds to earn 2 continuing education credits. We will be tracking a number of topics here. As we said, this will be a 2-hour course to earn 2 CE credits. In the first hour, we will begin with some surety basics and definitions so that you all can build a foundation of commercial surety knowledge. For the first hour, we will be speaking mostly to the licensing and permit bond business, covering topics like basics and definitions, guarantees, renewals and rating, common clauses, and underwriting practices. Then we'll take a 10-minute break. In the second hour, we will finish up the final details of license and permit business, including underwriting practices for large accounts, as well as the claims process and some examples of claims. For the remaining second hour, we'll discuss public official bonds, including basics and definitions, types of officials, different forms, underwriting practices, the claims process, and examples of claims. So let's kick things off. Let's start with the overall basics of surety and provide some definitions as well. Surety bonds are a 3-party agreement between an obligee, a principal, and finally, the surety. Let's break down each party, starting with the principal. The principal, or otherwise known as the applicant, is the party who needs the bond. They are the party bound to the requirements of the bond or contract to perform the work. Then there is the obligee, who is the party that requires the bond. In the commercial world, this will usually be the state, a city or county, and at times a government or professional organization. They are the ones needing the applicant to be bonded for certain work. The final party is us, the surety. We are the entity that is obligated to be liable for the performance and for potential defaults on the bond. We are responsible for guaranteeing the work is done. The responsibility of the surety is to also reimburse the obligation in the event of a claim or potentially help fulfill the obligation if anything were to arise. So that is the 3-party agreement, and that is what makes surety slightly different to insurance. Now we will get into the categories of commercial business. So as I'm sure you've all heard, commercial covers a wide variety of bond types. We cover license and permit bonds, public official, court-related bonds, probate bonds, and a number of other miscellaneous types, which would be classified like financial guarantees, wage and welfare, notaries. All of these would fall under the commercial umbrella. So if you ever have any related questions for the commercial staff, please always feel free to reach out to a Merchants underwriter. We are more than capable and happy to help in any way we can. Now, as we mentioned earlier, we will have several polls throughout this presentation today where we will ask you questions and you will have a moment or two to respond to them. Let's start with this question for you all. How many of the following bond types have you all seen? Thanks again for your answers. It looks like many of you have a wide variety of experience with these bonds. So now we are going to focus on the two primary forms of commercial business today, that being license and permit, which I'm sure a number of you are quite familiar with, and public official. We'll begin with license and permit business, otherwise known as L&P bonds. So license and permit business is probably the most common type of commercial business that you will all come across. License and permit, otherwise known as L&P bonds, refers to a wide range of bonds that are required for anyone to become licensed in a regulated area, or may be required for permission to conduct a one-time job. The bond guarantees compliance with laws and regulations governing the business, including payment and taxes and overall consumer protection. Now, license and permit bonds are generally required by larger government entities such as states, counties, municipals, things of that nature. On occasion, you will have a commercial bond, and sometimes a L&P bond needs for perhaps a certain job. But more often than not, that can be one-off. But more often than not, this will be a larger government entity as the obligee. L&P bonds can vary to many different sizes, but I assure you that they are all important business. A large number of L&P bonds requirements are really you'll come across a lot of these throughout everything. So it is important to get a good understanding of how L&P business works and why you should be seeking this as a type of business to market. Now, let's get into some of the guarantees of L&P bonds. So license and permit bonds generally have different types of guarantees. Now, one of the main focuses are compliance-only guarantees. These types of bonds guarantee an applicant will operate in accordance with state laws and ordinances. Generally, these bonds will have a paragraph towards the bottom of the bond form, as you can see on the slide. They will usually start with language that says, "Now therefore, the condition of this bond," and then it turns into a paragraph of law and official sounding language that may sound scary. I assure you, it's not scary. It's just the language that guarantees that an applicant will comply with the laws and ordinances and do the proper work required of the bond. Now, as I mentioned, L&P bonds are generally written by and required by government entities like states or entities of that nature. So there are laws, statutes, ordinances in place that applicants have to comply with. And just because you have one license and permit bond does not mean it will cover everything. For instance, you could get an electrical contractor license and permit bond for the state of Texas that may work. But perhaps in the city of Dallas, there is a secondary electrical contractor bond that an applicant would have to get in order to do specific work in the city of Dallas. As you'll come to learn, license and permit bonds aren't always a one-size-fits-all in a sense. Now, on to the next slide. Here we will discuss performance obligations. This will generally be a paragraph on a bond form, as you can see here in the example, that outlines the job details or related laws that applicants will have to abide by while doing the job. These paragraphs will also outline the length of the bond term. Occasionally, you'll have bond requests that have specific effective or expiration dates that a bond has to abide by. This paragraph is very important to understand because it will not only help explain the nature of the work, but help determine exactly what kind of bond you will need. Now, the last piece that it also guarantees are the payment obligations. This one is mainly what it sounds like. It will guarantee that not only will they comply with the law, but they will pay the proper taxes and make proper payment for the bond in a timely manner. These guarantees will normally be in the same paragraph as the performance guarantee. The payment guarantee will also be there on the form to ensure that any surety that writes the bond will reimburse the obligee in the event of any defaults of work or payment. Now, with license and permit bonds, as I'm sure a number of you have come to learn, is that these bonds more often than not will renew. This is one of the great ways that commercial business is very profitable because commercial L&P bonds are generally needed for much longer than a standard contract bond. Now, there are a number of ways that they renew, and we will cover that as we go further into this. So the main ways that commercial bonds renew are in three major ways. A bond can be continuous, meaning that they will just renew automatically. Some bonds will renew with a continuation certificate, which means it will renew with a special document that must be filed along with the bond. Finally, we'll also have the renewal bond, which means a new bond and new documents will replace the existing bond at renewal. Those are the major ways that commercial bond business renews. Now, you will have some commercial bond types that are set to non-renew, but that can depend on bond types itself. A good example of a bond type that generally non-renews would be a certificate of title bond. Now, let's discuss the ratings of bonds. So as you can see here, we at Merchants are licensed in every state in the U.S. When writing commercial bonds, every surety must file rates on specific bond business in every state. Some rates may be the same for similar types, and some states may even require certain rates. But ultimately, every bond will have a different rate. It just depends on the bond and the surety. So an example here on the slide you'll see is a $10,000 you'll see a $10 rate. What that ultimately means is that for every $1,000, it would be $10. So a $10,000 bond would ultimately equal out to a $100 premium. I understand that may sound like a low number for premium, but I assure you with commercial business, you would be quite surprised how many $100 little bonds like that will quickly add up and become a very large and lucrative book of business. Now, a number of commercial bonds that can have unique requirements when it comes to rates. They can be flat rates or tiered rates. There can be term rates and minimum premiums. Now, a tiered rate means that a bond can have different levels of rate and premium, and it can be decided on a number of factors. I'll use a great example of motor vehicle dealer bonds. Depending on surety, every surety can have a different underwriting process, but one example for motor vehicle dealers is rates can be determined based off underwriting requirements such as credit score or financial strength. So if an applicant has a certain score, they may qualify for a higher rate or a lower rate. These are rates that would have to be filed with the state. Now, we'll get into term premiums. A good example for a bond type there would be public official bonds. Term premiums are calculated based off the number of years a bond is going to be needed. And then finally, we will go into the minimum premiums. Minimum premiums are obviously what it sounds like. This is as low as we can legally go to file a bond. Now, most states will require a $100 minimum premium, which is common practice. Some bonds can be unique in that nature. Now, we are required to abide by those obligations. Just because we like you as our agents and our partners, we can't always just give you the lowest rates just because we want to. We have to abide by what the state sets. Now, one last thing I like to cover there is, now with some sureties, along with merchants, we have the capability to file account rates on bond types or bond accounts. We'll get into that a bit later here. Now I'll turn this next slide over to Robin.
All right. Thank you, Nick. So Nick went over bond guarantees, renewals, and rating. What else does a surety need to consider when reviewing bond obligations? Each bond runs to a different obligee, which is comprised of different laws and rules, and on different bond forms. We see bonds required by the state, by counties, by municipalities, and definitely on the federal level. So as you can imagine, there are thousands of different bond forms out there and different ways to review them. I'm going to go ahead and add on to what Nick has mentioned and discuss common clauses and conditions that bond forms may contain. I'll break the clauses down into two categories. We have liability clauses and difficult language. This slide is a breakdown of liability clauses. We have cancellation clauses, third-party liability, which can be direct or indirect. There's cumulative liability and aggregate liability. And we'll go more in depth in the next few slides on each one of these. I just wanted you to keep in mind that this is not all-inclusive, but there's more of the common clauses that we need to look for when you're underwriting a bond. Okay, so our first common clause is a cancellation provision. On this slide, you can see that the bond form reads, this bond may be canceled by giving the surety 30 days notice of cancellation. This cancellation clause allows the surety to cancel the bond by providing the 30 days notice to that obligee. This allows cancellation for non-payment of premium, for principal requests if they no longer need that bond, or perhaps there's an underwriting decision behind the reason to cancel. We have the ability to cancel. Now, what if it's a continuous bond with no cancellation clause? The surety or principal wouldn't be able to cancel the bond, which makes it riskier to write. Bonds that I see very often with no cancellation clause are right-of-way bonds. These bonds are required for a permit to use the obligee's right-of-way. So you were thinking, digging under a road or tearing up a sidewalk, a driveway, something that is public property. It's the right-of-way of the obligee. And these bonds are only released after the obligee inspects the job site and signs off on the condition of that right-of-way. So keep in mind the principal needs to continue to pay annual bond premium even after the job is done but not signed off on. That's very common. I just want to point that out. All right, so how about the difference between a 30-day cancellation requirement versus a 180-day cancellation requirement? Well, a lot can change in 6 months versus 1 month, right? A long cancellation clause can make a bond more risky for the surety company. We also want to consider if there's a discovery period after that cancellation. Depending on the bond language, claims can be made during the bond term or potentially for several years after. 5-year claims tails can mean the surety will be liable for 5 years after the bond has been canceled. Even if a bond has a cancellation clause, a claims tail still needs to be reviewed as well. Again, a lot can change in that time frame. The principal could have gone out of business, but the surety is still liable for their obligation, but will have no way to recoup if there's a claim that's paid out. So understanding that cancellation provision is important and helps the surety underwrite the bond profitably. All right, moving on to third-party liability clause. An example on this slide is the state of Arizona allows the bond claim to be paid to the state or to an interested person. Basically, this allows the consumer or a third party to benefit from the bond, not just the obligee, the state, city, etc. Third-party liability does increase the likeness of the claim. We definitely have a lot more claims on these type of bonds. It's a very common condition, especially among contractor license bonds that are intended to protect the consumer. So what's the difference between direct and indirect liability? With direct liability, the consumer can place a claim directly with the surety company. The obligee is not there to filter out nuisance claims, and the surety must determine the claim's merit. The surety also needs to consider the possibility of multiple claimants and how to distribute the bond penalty. So there's a lot more work on our end. With indirect liability, the obligee reviews the complaint before sending the claim to the surety. The obligee filters out the claims after it's determined the intention of the bond. All right, so cumulative liability. This condition basically means that the bond penalty can accumulate or stack each year the bond's in force. As you read on this slide, you'll notice the words cumulative and each year. The cumulative language can be expressed in the bond form, such as on the slide, or in the statute. We see this often when new bonds are issued each year as mentioned in the renewal section, and there's nothing in the bond or statute that limits the aggregate liability. For example, if there's a $10,000 contract or license bond that's enforced for 10 years, the surety potentially has $100,000 liability on that bond. However, we'd need to have a full claim each year that wasn't discovered for 10 years to pay out that $100,000. It's very highly unlikely that the obligee or surety company wouldn't discover a contractor with poor practices over the course of 10 years, right? So the surety just needs to be aware of this language and just underwrite it accordingly. All right, aggregate or aggregation clause. An aggregate clause is wording that would specifically limit our liability. As mentioned on the prior slide, the cumulative language typically does not have an aggregate clause. In reading this bond form, you'll note the words, aggregate liability of the surety under this bond shall not exceed the penal sum of the bond. Sureties prefer to see this language. If the language is not on the bond, again, check the statutes, the administrative rules, or how does the bond renew? Is it continuous? Is it continued by certificate or by renewal bonds? Okay, so the next 5 clauses contain difficult language for a surety. These clauses are a demand clause, forfeiture clause, in lieu of insurance, selection against the surety, and attorney and court fees that are outside the bond penalty, and we will go through each one of these in depth here. So this slide is an example of demand language. Demand language is a time frame in which the surety is required to pay out on a claim. The demand condition gives parameters, so it's not necessarily a bad thing. However, when we only have 10 days, as the form on the slide shows, the surety does not have the time to investigate that claim. We'd have to pay out according to the bond requirements and then just backpedal and try to recover the amount paid out to the obligee if the claim wasn't valid. This next slide on difficult language is forfeiture clause. This bond form is the State of Idaho mortgage loan originator. Basically, the forfeiture means that the whole penalty of the bond is given to or forfeited to the obligee. Each claim could be 100% of the bond. Keep in mind that forfeiture language can be found on the bond form and or the statute, so this is very important to review. And I'll point out this example on the slide that we have right here is for the Missouri Department of Natural Resources. It's a surface mining of minerals surety bond. The bond form itself says that the surety can cancel the bond within 90 days notice, which is good. We like the ability to cancel a bond if we need to, such as financials no longer qualify, etc. However, if we take a look at the statute, it says if no substitution is made in 60 days after receiving notice, the director may pursue forfeiture of the operator's bond. So basically what this means is if the surety company does choose to cancel that bond for whatsoever reason, if that operator cannot replace the bond with another surety company, we kind of just walk into the claim, right? So this is a very, very common on any kind of environmental type bonds like reclamation bonds or closure, post-closure bonds. These are where operators, operate either a mine or oil and gas well. And basically, if you think about it, these bonds are going to be enforced, or those operations are going to be enforced for maybe decades. So a state really wants to go ahead and just protect themselves, and that's why they have these clauses in here. And generally, a lot of these times, it's specialty surety companies that will write these type of bonds and require collateral because it's not very easily cancelable. All right, so next clause, we have in lieu of insurance. Basically, this language is that the bond form or statute asks for a surety bond in lieu of insurance. So as you read here, the Kentucky Pharmaceutical Wholesaler License requires an applicant to get a surety bond for $25,000 or insurance, a letter of credit, or a trust account. So just keep in mind, surety bonds and insurance are intended to cover different things. The surety bond is to protect the obligee or the public, and insurance is to protect the insured. We want the principal to be insured and bonded. A surety company does not want to pick up general liability on a principal. All right, so this slide covers selection against the surety, also known as adverse selection, in which only those principals that have the highest probability of loss are those that are required to obtain the bond. If the obligee only requires the highest risk to be bonded, it reduces the surety premium, as well increases our chance of a loss. So some examples are on this slide. If the principal doesn't meet a certain D&B criteria, then they need a bond. The D&B is the business credit report, Dun & Bradstreet. So if there's something on their D&B or doesn't quite make qualifications, they have to get the bond, right? Other cases is if the principal does not meet a capitalization requirement, they need the bond. So if they don't have the net worth that the obligee requires, then they will be required to obtain the bond. But if you think about it as well, as if they can't qualify for the waiver, most likely they financially can't qualify for the bond. We also see bonds required if there are past payment issues. So for example, utility deposit bonds. If a utility company is not being paid their monthly utility bill, they may ask that principal to get a bond to protect themselves in case there's future problems. We also see bonds being required for new businesses, so the businesses that don't have experience. And last example is basically a bond might be required if the principal does not meet a certain financial statement preparation quality. An example is that we see a lot are just out-of-state contractors. They're required to have a CPA audited financial statement or get the bond. And now a CPA audit is a very expensive and extensive report to get, so not every principal will get an audit, and you may come across this as you're reviewing applicants. But some applicants that, some states that have these requirements for out-of-state contractors are North Carolina, South Carolina, Tennessee, and Arkansas is what we see most often. Okay, so the last difficult clause or condition I'm going to go over is when the attorney and court fees are in excess of the bond limit. This can allow for unlimited exposure. How do you underwrite since attorney and court fees can add up quickly? The example on this slide is actually only a $1,000 bond penalty. If the claim goes to litigation, though, it'll most likely increase the surety's liability much higher to $1,000. Just keep that in mind. Again, these are more common, but not all-inclusive. Just keep an eye out for when you're reviewing bond forms and the underlying statutes or ordinances. And that wraps up reviewing and underwriting the bond form risk. I'm going to go ahead and pass you back over to Nick to discuss what underwriting an applicant looks like.
Thanks again, Robin. And that was a great way to cover the clauses in commercial surety bonds and ultimately how they can make some bonds difficult to underwrite. Now, what we're going to go over here is the underwriting process for license and permit bonds. Now, as I mentioned earlier, license and permit bonds are not a one-size-fits-all kind of situation. Every L&P bond will be different from one another in regards to what the obligation is, what the bond amount is, and ultimately what the underwriting requirements are. Now, every surety will underwrite L&P bonds differently. This is definitely true, but I'm going to just cover how Merchants does the underwriting. One thing that makes Merchants unique is how we break it down into underwriting classes, and most importantly, that we share this information with you, our agents and our partners. Merchants Bonding Company's website has a bonds form library for commercial business that contains thousands of forms across all 50 states. And every one of those bonds, you can look them up in our system, and you can see how we underwrite them and what the underwriting requirements are. So we have 6 different classes, class 1, 2, 3, 4, 5, and 6. Now, how these ultimately work. Class 1 and class 2 bonds are ultimately bonds that are freely written, meaning we don't require any kind of additional information outside of the essentials. You just submit it online and the bonds go through automatically. The difference between class 1 and class 2 is maybe a bond type requires us to follow up for indemnity. That's the only difference between the two of them. Class 3 bonds means we will require to run credit on the applicants in order to qualify them for the bond. Now, a good example of a class 3 bond would be motor vehicle dealer bonds. In most states, we underwrite it as a Class 3. That means we just need to run a quick credit check on the owners and the applicants themselves. In that situation, you would just provide us with their names, address, social security numbers, and then we run the credits. I will tell you now, it is always a soft credit pull. It will not affect their overall score, or if that is ever a concern. Ultimately, that's what Class 3 means. Class 4 bonds can be considered a full submission. This means we would still need to run credit on the applicants, but we would also need financials. Now, Merchants Bonding Company is a very net worth driven company in regards to our financial decisions. So whether it be a business financial statement or personal financial statement, we can use either to qualify an applicant. We can also accept both, and by accepting both, we can take the net worth from both statements to make an applicant stronger. Not always a requirement for both, but never hurts. A good example of a Class 4 bond type would be a financial guarantee or a wage and welfare bond. Now, with Class 5 bonds, this means things are a bit harder. We would still require a full submission with the financials, but we would require collateral in order to consider it. A perfect example is a bond type I'm sure you are all familiar with and dread hearing is a release of lien bond. For collateral in those situations, merchants typically takes cash, irrevocable letters of credit, also known as ILOCs, and in some instances, property like real estate. But we'll cover that in more detail later. And then there are Class 6 bonds on our website. Class 6 bonds on our website means that it is a bond type that Merchants Bonding Company is not a market for at this time. You are always free to reach out to your underwriters and ask them why we are not a market for these bonds and if there's a potential way for us to reconsider. But ultimately, Class 6 means we won't write it. And for a number of it can be for a number of large reasons. Good examples could be a number of the clauses that Robin just covered briefly. Now, I'm sure you're all going to ask about indemnity. We do require indemnity on a number of bonds, but merchant's policy is typically on the commercial side that if a bond is below $75,000, we can waive an indemnity signature requirement. Anything north of that we can potentially waive it on a case-by-case basis. Ultimately, that will just comes down between you and your underwriter. Applications with the indemnity agreement will always be available for agents on our website. So as we move on to the next slide, I'm going to go over one of our most important tools, not just for commercial bonds, but for surety bonds as a whole, and that is the commercial bond application. Now, we've discussed the bond form risks and the language to look for on the forms and the guarantees and the clauses. All of this is essential information that helps you, the agent, and us as the underwriter determine what we need. But a great tool that helps us make this a much more clear-cut description is the application. Now, our application, as you can see here, is available on our website for everyone. The application is normally 3 pages long, but it doesn't mean you have to fill out every bit of information. Normally, we can get away with just using the first page, as you can see here. The application will contain, on the first page, information for the applicant, such as their name, address, section for their social security number, and overall ownership structure. By filling this out, this can give the surety most, if not all, the information it needs to qualify a bond and help determine what type of bond the applicant needs. Our application also contains multiple sections on its second page not shown here, that break things down into bond type categories. For instance, we would have a section for public official bonds. We would have a section for financial guarantee bonds. This just helps fill that. It's not always mandatory to fill the second page out, but again, it is another tool that is very useful in helping gather all this information up front. Finally, the third page of our application contains a balance sheet statement. We can use this for business financials and personal financials, depending on the submission itself. It's laid out in a balance sheet format, meaning we will see the applicant's assets, liabilities, and overall their equity. As you can see, the application will outline the indemnity agreement on the first page. If an applicant has any concerns about the indemnity agreement, they can reach out to the surety and see if any possible changes can be made. This is always feel free to reach out to that if you have questions about the indemnity. We are more than capable of working with you if there is something that is reasonable. Finally, you'll see the signature sections on the application. Generally, we would like the applicant to sign twice, once as the applicant and once as the indemnitor. As for the witness section, anyone can be a witness, including the agent. Merchants does have the capability to accept e-signatures on these bonds, in case anyone was curious. Now, before I turn things over to Robin, I want to cover another tool that we have is account-driven underwriting. Now, what does that mean? Account-driven underwriting is a way we can write multiple bonds at a time for an applicant or an account. Let's say we have an applicant who has a lot of L&P bond needs, along with other commercial bond types like notary or utility bonds. We could set this applicant up as an account with merchants. It's honestly a fairly similar process to setting up a contract account. Now, in those situations, we may ask for more information upfront. Depending on the size of the opportunities, we may require higher items such as indemnity or financial statements. But most importantly, we would need to understand what types of bonds are tied to this account. Maybe it's all just small, easy L&P business. Maybe it's something a little more complex. But ultimately, we have the capabilities to write a large number of L&P bonds for an account, so it doesn't have to be a one-off situation every single time. With account-driven underwriting, it could be a great tool to handle incoming bond requests for the same applicant. We can be less strict about underwriting requirements for the account moving forward, and even in some instances, some sureties have the capability of filing special rates for account-driven bonds. That, however, is on both a surety-by-surety and an account-by-account basis. If you know you have a book of that type of business, Merchants is more than capable of underwriting it in a similar fashion. Now, one other tool that I want to talk about before we turn this over is collateral. As I've previously mentioned, we do have some bond types that are harder to place, and collateral is almost always a requirement to get those bonds to happen. In some instances, we can use collateral to help strengthen an account. However, that does not mean posting collateral suddenly makes a bad account a good account. We at Merchants accept 3 types of collateral. We accept cash at 100% of the bond amount. We accept an irrevocable letter of credit, or ILOC, at the same amount. And securing an ILOC is something that applicants would have to secure through their banks. And finally, the last type of collateral we can accept is real property, such as real estate of a home or something of that nature. That one's a little less common to happen. Another tool that is very important in getting some harder business done, or just business in general done, is the indemnity piece. You all know that everyone knows that indemnity is a very important tool. Now, I'm sure we all have dealt with applicants who don't want to provide indemnity or provide personal indemnity. That is something we can work around if necessary. In some instances, we only need corporate indemnity for a bond. That's something we can work with. Personal indemnity is always helpful, especially if we are using personal financial statements in order to qualify accounts. Spousal indemnity may be a requirement occasionally, but not always a requirement and can always be discussed with an underwriter. And in other instances, we can accept outside indemnity. Now, what I mean by outside indemnity would be such as a parent company or a related entity. Let's say an applicant has started a new business and this new business has no financial strength, but a parent company or related business that the owners own has the financial strength. What we could do here is we would use the financials of this related entity to qualify the new business for the bond. But to do so, we would have to secure the corporate indemnity of the related parent or related entity. That is another great tool that we can use. We try to work with you, our agents, as much as possible with these types of things. So it's always good to have all of these tools in our tool belt. Now I will turn this over to Robin here for the next slide.
All right, thanks, Nick. Okay, so we've gone over underwriting a bond form, as well as how do we underwrite an applicant. So we're going to go over a few different examples, putting this all together here. So our first example is just underwriting a single bond. And this bond that we're going to look at is the Illinois Village of Oakwood Hills $10,000 plumber's bond. All right, the first thing is to look at the bond risk, right? So every plumber must get the bond to work in the village, so there's no adverse selection or selection against the surety. The village allows the bond to be issued on the surety's generic license and permit form. So it has the surety's wording and terms. It's our generic LNP form with a 30-day cancellation clause. We can also choose continuous renewal or continued by CC, so again, our terms and how we renew it, unless it's outlined in a statute differently. We can also add an aggregate clause so the bond does not accumulate. So all this, we like to use our generic forms. Now, the bond guarantees the principal abides by the village's building codes. It's a compliance bond. There's no performance or financial guarantees in this specific form. And the bond's not a very high limit, it's just $10,000. And then reading the village ordinance, the obligee is the only one that can place a claim on the bond. There's no third-party liability. Now, on the underwriter side, we take a look at loss ratios as well. There's very low losses on this type of bond. In the state of Illinois, there's a loss ratio of 2.1% over a 5-year span, so that's really low loss ratio. So how are we going to underwrite that applicant? Generally, we're not. We're going to write this bond fairly easily with minimal underwriting. Like Nick went over, it's Class 1 instant issue. All right, so there's our first example. Our second example on underwriting an individual bond is a $100,000 California CSLB LLC Employers Worker Bond, and that's the contractor's state license board for the state of California, CSLB. Okay, so the bond amount is $100,000. The bond is on the state's own bond form that they drafted, and that's very common with most states. At that level, they'll have their own bond form. The bond form has a 30-day notice of cancellation, so we can cancel the bond. The bond limit is a little bit higher since it's $100,000. Our last example was just $10,000, so we are looking at a higher liability on this type of bond. Now, every contracting LLC must get this bond, so there is no adverse selection when they're applying for the license in California. Now, what is a bond guarantee? Basically, it's to benefit the employees damaged by his or her employer's failure to pay wages, interest on wages, or fringe benefits. This is a safeguard for workers employed by a contractor to work for an LLC. The bond has a financial guarantee component, so there's a little bit more risk. There is third-party liability exposure. However, that third party has to go through a court to file a claim, not directly with the surety, so there's a little bit of a filter there. Now, there's also a 2-year claims tail, which is longer than the 1-year claim period. So overall, this bond is a little bit more riskier than that village bond that we just took a look at. Now, loss history, it still is a little bit lower of a loss history. Generally, contractor bonds are a 5-year loss ratio is 9%, so not completely terrible. So how are we going to underwrite this applicant? First off, we're going to gather the application, like Nick mentioned, information on the name, address, owner's information, that kind of general stuff, so we get to know who our applicant is. We need to know what indemnity do we have. Do we have the LLC's indemnity as well as personal owners and spouses indemnity signatures? Now, take a look at your credit report, the individual credit report of the owner, just to make sure that they can pay their individual bills and that is clean and up to date. We can also take a look at the business credit report, which again is the Dun & Bradstreet. Make sure there's no liens, there's no lawsuits, anything detrimental to underwriting on those reports. A very important item that we do look at, especially for California, and you can do this for a lot of different states for their contractors, is take a look at the state website. Review the license, if they're a licensed contractor, and what status is that license in. Again, this is just public knowledge, so anyone can go ahead on these websites and take a look when they're reviewing for hiring contractors. Surety company will do the same thing. And then maybe we'll take a look at the principal's website. Is the principal a roofing contractor but applying for an electrical license bond? Just kind of want to connect some dots there to make sure it makes sense. And then another tool that we have are personal or business financial statements. Does the personal or business have a positive net worth? Do they have cash or working capital to pay out on a claim if the bond goes into a claim situation? We can also just Google. Google is a wealth of information out there. You can always find either good information or adverse information, so it's just a great tool. So these are the tools that we have for that single bond. Merchants, though, just to give you a heads up, is we underwrite these based on credit reports of the applicant, as well as take a look at the California licensing website. So class 3, like what Nick had mentioned earlier. Okay. So we took a look at 2 single individual bond forms, but now what if that contractor needs several bonds? So it's a small contractor. We'll just build on to the last couple slides. So we have a $10,000 village bond, we have a $100,000 LLC workers bond, and that usually goes hand in hand with a $25,000 California contractors bond as well. And then let's throw in a $25,000 Iowa contractors out-of-state tax bond, which is a financial guarantee. So our bonds, we have compliance and financial guarantees. And then we want to take a look at the aggregate exposure. We have a total of $160,000. So we're going to kind of underwrite this a little bit more thoroughly than what we did in the last 2 slides. And we're going to go basically over all those same steps that we went to before. We would take a look at the application. We would review owner and personal credit. We'll take a look, most likely at this aggregate, take a look at business and or personal financial statements. And then generally we will review what's the experience of the contractor. Are they new in business or have they been in business for 10 years? That's always really good to know. It makes the surety company feel a little bit more comfortable with the rest. And again, what surety do we have? What indemnity do we have? So do we have corporate, individual, spouses, stuff like that? And as we mentioned, take a look at the state licenses. That's, again, public information that anyone can review, and the principal website. Does it make sense? For example, why is our contractor in California and Iowa? So you may want to double check if they're a nationwide contractor or whatnot. So, and that kind of, okay. So that's basically how we're going to take a look at a small account. What we're going to do is take a 10-minute break here in just a moment, and then Nick was going to come back and discuss underwriting a larger account. So go ahead and take, stretch, get something to eat, use the restroom, that kind of stuff, and we'll come back in 10 minutes.
Welcome back, everyone. I hope you all enjoyed your break. And I wanted to say thanks again for Robin for taking that up and going over some of those opportunities. Now, as mentioned, I will be going over how merchants can go about underwriting a large, diverse account. Now, some of these larger account opportunities can comprise of bonds that are a little harder to do, some or not as standard as usual standard L&P. We can get right-of-way requests. We can get encroachment bonds. We may get utility bonds, wage and welfare, release of lien, even some contractor license bonds. All of these are well within our wheelhouse of being able to handle, but when it comes to creating an account for this, these types of bonds can be a little more unique in regards to what we need from an underwriting standpoint. Now, the real question for handling large accounts is how are we going to tackle this? First and foremost, we need to understand the risk of the account. What are the bond types? What are we guaranteed in their overall exposure? And most importantly, are we a market for these types of bonds? Because that is a very important detail. We could be a market for 95% of the book of business, but the other 5% could be bond types we are not able to write. And that'll happen occasionally. Sometimes there will be bonds that tied to an account that merchants doesn't have the capabilities to underwrite, such as oil and gas business. Understanding the risk is obviously the most important piece of underwriting bonds in general. So then the next approach we need to go into for handling large accounts is we need to understand the overall size of the account, or otherwise known as the aggregate exposure of the account. We add all of these bonds up together. What is the risk? How big is the risk truly as a whole? Now that leads us to help determine, once we know the overall aggregate exposure of the account, it'll help us determine what we need from an underwriting standpoint for this account. Will we need financials? Will we need both business and personals? Are we going to need indemnity, both corporate and personal, possibly even spousal? Obviously, we need to also then ask, how far back are we going with the financial statements? Do we need multiple years? These are all conversations that are important, and most important, they're conversations that you can have with your underwriters to try to make this as smooth as possible. Now, the last thing that we worry about with these large account types of submissions is we also want to understand who the applicant is. We want to understand, is this an insurance client of yours, or is this a newer opportunity? What's the scope of the work they're doing? What's their experience level? These types of questions and tools are all really necessary when you're trying to write larger accounts and trying to determine if it can be done as one-offs or if it truly does need to be set up as accounts are important questions to always be asking yourselves. Now, I'm sure people probably do it on the contract side as well, but a lot of these things do translate very similarly to commercial when we are establishing accounts. I would strongly advise that before you submit something large or something that seems a bit convoluted, that you have a conversation with your underwriter about it. So that way we can figure it all out from the beginning, and we can help save each other some time. Now, Robin is going to cover how we go about issuing some bonds.
All right, thanks, Nick. So we have, underwrote the bond. The bond has been approved. What are your next steps? And we put the slide out here because issuing a bond is much different than issuing an insurance policy. So what is the agent's responsibility and the principal's responsibility at this point? So the first step is the agent is going to complete the bond form. So basically fill in the blanks, who's the principal, the address, what license are they applying for. You can either do this in-house if you have your own issuance system, or you can most likely, and nowadays is issue it on the surety company's bond issuance system. That'll help guide how to complete the bond form. Next, the attorney-in-fact or the agent or the CSR, whoever has authority to sign on behalf of the surety company, will sign that bond as attorney-in-fact. And they'll attach a surety seal generally over their signature. And to the right, you will see what is a sample of merchant's bonding seal. So generally, the seal is going to look very similar to like a notary public seal. It's those crimper seals that you emboss a bond on. And that's what you should probably have with most of your surety companies, or there's going to be electronic seal, just like we have right here on the right. Next, a second document that you'll attach to that bond form is called a power of attorney document. The power of attorney is a form that's provided by the surety company that gives authority to that attorney-in-fact to sign on behalf of the surety company, so it's authentic. Next, which is really important, is provide the bond to the principal to sign the bond. They actually do have to sign the bond on the signature line, make sure that it is completed. Again, that's just very important because the obligee can reject a form that is not signed correctly. And then the next step, after everybody has signed that form, the principal is going to remit the bond to the obligee. Generally, this is going to be with their license packet. They do not want to send that bond back to the agent, do not want to send it back to the surety company. We're done on our end. They want to remit it to the obligee, and it's a good idea to have everyone have a copy of that bond form in file, just so that way if there's a question down the road. So you may have noticed, especially since COVID, a lot more obligees are accepting electronically signed bonds or electronically filed bonds. And this makes it a little bit easier on the agent and the principal because they don't have to touch the form as much as what we just discussed. So, for example, if you have to print that bond form out, sign it, seal it, scan it in, maybe mail a copy or deliver a copy, if you have an electronically signed bond, generally you can just go ahead and email that over to the principal to complete on their end. So it makes it a lot easier to do business. And merchants, our system on the hub has a lot of these electronically issued bonds that try to make it a lot easier and less time consuming for all you guys to issue our bonds. And again, there's a lot of obligees that are accepting electronically filed bonds, so bonds that are filed on their website. And one example that we went over just shortly ago is the California CSLB bond. California allows the surety company to issue that bond on their system. So the agent or the principal do not have to do anything further. Merchants, we have a special setup, so every night we have an automatic sweep that every bond that was issued for California CSLB will go automatically reported to their system and filed with their system and the contractor's license, and that's through an API setup. Other examples we have are the nationwide multi-state licensing system, or the NMLS, which is generally for more financial type of businesses. So you've got your loan brokers, loan originators, mortgage lenders, and in that financial industry, a lot of states are allowing bonds to be uploaded to the NMLS system with their licensing, and then the principal will go to the same system and sign the bond electronically as well. So again, it just saves a lot of time. And my final example that I see very often is just the ICC broker bond. It's a $75,000 bond required by the FMCSA for property brokers. It's also known as a BMC 84. The FMCSA website, which is the Federal Motor Carrier Safety Administration for trucking companies, it's a public website that anyone can see that bond is filed up to date, live, real time. So that's very convenient for sureties, customers, their customers to know that the bond is valid. All right, so we've been over issuing a bond. So let's discuss what the purpose of the bond is. It's to protect the obligees who can place a claim on the bond and recoup from the loss, right? So surety companies have claims departments. We have claims examiners. What do these claims examiners do? First step, they will review the bond form. Who are the parties involved? The obligee, principal, etc. What is the effective date of that bond? What are the terms and conditions of that bond? Next, the claims examiner will review the underwriting file. What information was provided to the underwriter? Is there an application on file with contact information? Whose indemnity is available? Whose signatures are on that application? Were there any changes or riders issued during that term, meaning, change a dollar amount, maybe change the principal name if they changed businesses? What is the status of the bond? Is it active or has been canceled or non-renewed? Next, the examiner will review the claim information, determine the merits of that claim. What are the conditions of the bond, statutes, codes, case law as it pertains to the basis of that claim? And they'll investigate that claim. As well as that examiner will also notify the agent, so you'll find out, the underwriter will find out that there is a claim on that bond. We'll communicate with the principal, and when the examiner communicates with the principal, they'll provide claim documentation, bond forms and riders, provide the indemnity agreement or language advising of merchants' common law rights. They'll request a response with supporting documentation set by a set date. There's a due date. Next, they'll acknowledge the claim to the claimant. And same thing that they did with the principal. They'll provide a copy of the bond form. They'll outline the terms and the conditions of the bonds, what's the purpose of that bond, and request for additional information. Usually it's called a proof of claim form, and any other additional documentation that helps support that claim. After they've reviewed this claim, that examiner will either affirm or deny the claim. If a claim was paid out, they'll pursue reimbursement against that payout called salvage, or provide a demand letter to the principal. Sometimes, every once in a while, we'll see a settlement letter to the principal. So, for example, recently we had a bond where there was a $30,000 payout on this specific bond, but that principal was going out of business. So we knew it was a difficult time for them to pay that $30,000. So we asked for $15,000 just to recoup some of our loss and kind of call it a day. If the bond goes to litigation, merchants will request an attorney for the principal to tender defense. So we will ask the principal who's their attorney. If there's no attorney provided, the case is assigned to an outside counsel for handling. Right, so how do you submit a claim? The principal or obligee will most likely contact the surety directly, but if information on a claim comes to the retail agent, you can submit the claim on their behalf, or at minimum, contact your underwriter of a potential pending claim. Claims can typically be submitted on the surety's website, as well with a provided phone number, email, or fax. You'll see there's our email, claims@merchantsbonding.com, and we also have an online submission form, which here's an example of a claim that came in through our online submission form, which is a claim amount for $9,000, and the description of the claim is hauled load from American Airlines, Texas to Florida, and the principal did not pay the $9,000 that they had originally agreed upon. So at that point, our claims department will ask for additional supporting information. So they've asked for a copy of the invoice, any type of agreement that actually says our principal owed them money and did not pay by a certain date. And this is just a sample right here on the screen. And this next slide is just a sample denial letter. This bond was a Washington State continuous surety bond where the contractor, our principal, did not pay the subcontractor for labor. The subcontractor went straight to surety to place a claim on the bond. However, the bond requires the claimant to go through the superior court. The surety denied the claim as the claim did not go through proper channels. This claim could still be valid and resubmitted at a later date after they go through the court. So some common claims that I see often on the underwriting side is just with contractors' license and permit bonds. For example, somebody may not be satisfied with their bathroom remodel, and they'll submit a claim on the bond. However, that's generally not a valid claim. Valid claims are going to be in that remodel. Maybe that's basically just like the plumbing or the electrical were not up to code, so that contractors are required to go in and fix that or put a claim on the bond. I also see claims fairly often for used motor vehicle dealers. So these are these are vehicles being sold that are used and they're not in mint condition. So a principal may not be happy with, say, for example, the brakes, and they'll put a claim on the bond and force them to replace the brakes, which usually is not the purpose of that type of bond. Usually dealer bonds protect our customers against lemon laws. So it's just basically a defective vehicle that needs to be repaired or replaced. Another example is just claims where the dealer has rolled back the odometer and there's less mileage on that vehicle, so they can sell it for a higher price. So we do see those type of claims. Not so often on newer vehicles, but it does happen on the older vehicles where that is something that can do. And then the last example I have on this slide is something that I do see very often is with our property brokers, which is the same as that sample I just showed a moment again for that $9,000. Basically, the property broker did not pay all parties, so there's a claim against that property broker bond. And generally, these are very small, maybe a couple $100, maybe a couple thousand, and usually we don't pay out on them. So it just takes a lot of time, of our time, the claims examiner's time, so we just need to be wary about that. So I'm going to go ahead and take a quick poll. This is not a required poll for credit. It's just for involvement and to get an idea of who's actually seen a claim on a commercial bond. If you could just take a moment now and just write yes or no to see who has actually seen claims on commercial bonds. Okay, you can go ahead and finish this poll up. I thank you so much for your involvement here. So we have some that have seen claims, and the majority of you guys have not seen claims on commercial bonds, which is a good thing because surety companies generally try to underwrite so we do not get a claim. But obviously claims occur, and that's the purpose of the bond, right? All right, so just go over a couple of claims that we have seen. This one right here is a logger obtained a right-of-way bond to use a town road while harvesting trees. The town then alleged the logger damaged the road and placed a claim against the bond for cost of restoration. The town provided the surety before and after pictures of the road that were several months apart. The condition of that road had obviously deteriorated in the pictures. However, the town was unable to provide a final inspection report that outlined the violation of the town codes. The town could not prove the damage was caused by our principal and with that specific permit and bond that was pulled. Therefore, we went ahead and denied that claim. Okay, and Nick will go over another example.
Thanks, Robin. So in this example, we have a car dealership that had a claim come against it. Now, in the state of Colorado, where this bond example comes from, this bond amount is fixed at $50,000. Now, the basis for a claim with these types of bonds are typically when there is fraudulent or incorrect paperwork. Someone is not documenting everything in the dealership as they should. With these bonds, they may be either with dealership bonds, they can be either on a 1 or 2 year term. In this instance, this bond was in place for 2 years and premiums are tiered. So in this example, the bond was enforced for 2 years and was charging a $450 premium. Now, an important piece of information for this type of claim and most other bond types is that the claim has to happen in the term of the bond. So this bond was enforced from January of 2018 to January of 2020. If the claims happen during this time frame and they can be proven, then they are valid. If they happen prior to the term or post the term of this bond, then if the bond wasn't enforced or active at that point, then we would have grounds to decline the claims. In this instance, however, the claims did occur during the term of the bond, and there were multiple claimants, 20 in this example. Certain bonds can only have specific claimants, where others like this can have multiple different types of claimants. Now, with claims in commercial bonds, you don't have to necessarily pay the full amount, and a number of bonds limit the aggregate exposure of how much can be paid out on a claim. However, some bonds don't have that language, and when you have multiple claimants on a bond, that exposure and payout on the claims can add up, possibly costing more than the overall bond. In this instance, we had about 20 claimants that proved to be valid that led to a payout of $78,000. 68,000 of that were due to the valid claims split amongst the 20 claimants, and then the additional 10,000 in loss adjustment expenses. Now, while this was not an ideal scenario, these things happen. Claims are a part of doing business. No one wants to write them, but it is just the cost of doing business at times. And every surety should have a dedicated department to handling these kinds of claims. And you shouldn't be too surprised when sometimes a claim payout is larger than the set bond amounts. It just depends on the number of claimants and the reality of how many of them turn out to be valid. Now, while we move on to this next section, and we are going to talk about one thing that I think you should all be wanting to know is how to go about producing license and permit business. Now, some of you may not have that much experience with commercial bonds and types like that. I know it may sound like a lot of work to cover all these and try to grow a book of business this way, but I assure you, choosing to actively pursue commercial bond business can be very beneficial for your clients, your agency, and can be very lucrative as well. So we'll want to figure out how to produce the business. Now, ways we can go about this. You could become familiar with local laws in your areas or other areas. You can review the types of commercial insurance that is written in those areas. You can look up the license and permit bonds and the markets for that area as a way to read into how to break into these areas or how to break into these bond types and ultimately figure out their requirements. You can access lists of licenses to create a mailing list. You can make updates to your websites to mention that your agency handles bond business. So when an applicant does a quick Google search of where to go get a bond, your names could come up. And this would be a great way to target specific types of business like notary or dealer bonds. Then you could also contact local associations. There's a number of surety associations in almost every city you could possibly think of. There are also contractor associations and electrical associations. There's an association for just about any kind of group or entity out there these days. And you can get in touch with them and see how they go about handling their bond business and what are ways you can be helpful in that process. These are good ways that you could find out more about L&P business, commercial bonds as a whole, and ultimately these are great ways that you could grow your books of business. So this first section should have covered kind of everything when it comes to L&P business. We've covered the basics and definitions. We've gone over the three-party agreement. We've gone over guarantees of these bond types and the different kinds of guarantees. We've covered the numerous ways of renewal actions. We've gotten into the clauses and language that is both beneficial and detrimental to bond types. What we need to look for in underwriting requirements. We've gone over how all of these classes are done and the underwriting tools that we have available at merchants for you, our agents, as well. We've gone over how to go out underwriting bonds from a single nature to multiple bonds to large accounts. We've gone over how the claims process works, and we've even touched on a few examples of claims. And finally, we just talked about ways we can grow this type of business. These are great commercial bond business, and also specifically license and permit bonds, is a great type of bond business that whether you seek it or not, it will come across your desk at some point in time. And hopefully this has all been helpful. So now we're going to begin our conversation on another very common commercial bond type, public official. And I will turn this over to Robin to get us started on that.
Thank you, Nick. For the public official section, we're going to go kind of over the same format. We're going to introduce you to public official bonds, go over the types of public official bonds that we see, what different forms the bonds are issued on, how do we underwrite public official bonds. We'll go through a couple application scenarios, some claims examples, and then just like Nick went over, is just how do you market for public official bonds? How do you get that business? So we're going to go ahead and take another poll. Again, this is not required for credit. It's just for a little bit involvement and to get an idea of who's seen public official bonds. So if you want to go ahead and just type yes or no into the poll section, we'll take a moment here. All right, we can go ahead and close that poll. And with your answers, it looks like about half of you guys have seen a public official bond, so good. For those of you who are new to public official bonds, this section of the course will introduce you to the purpose of public official bonds, why they're needed, how a surety company reviews them, and where you may come across public official bonds. For those of you that are familiar, hopefully this section of the course will give you more in-depth underwriting. So just to go over some basics, what is a public official bond? A public official is an individual who is appointed or elected to public office. The public official bond was developed to protect the public and public funds. It's a fidelity guarantee that guarantees honesty and faithful performance. The public official bond guarantees that the public official will not commit an act of malfeasance, which is the intentional wrongful performance of duty, think of criminal acts against the law. It protects, it guarantees that the public official will not commit an act of misfeasance, which is a mistaken wrongful performance of duty, negligence or ignorance, and also acts of non-feasance, and that's failure to perform a required duty, basically not doing their job description. So public official bonds guarantee that the official will carry out their legal duty and they will not misappropriate, steal, or embezzle public funds. This is generally considered a pretty desirable class of business. There's not a lot of losses if it's underwritten appropriately. And just some history on public official bonds. Basically, the bonds were introduced prior to the existence of corporate surety, which merchant bonding is a corporate surety. Previously, the government required private supporters who were financially stable to post bonds for public official prior to taking office. So imagine if you personally or if your business financially guaranteed the official will handle their duties in office, and if not, you're on the hook for the loss. You really want to trust that person, right? So just a fun fact, corporate surety was evolved to take that personal liability away from citizens, and it was evolved in 1800. So in 1865, it was Fidelity Insurance Company was founded and became the first corporate surety in the United States. And merchant bonding was actually established in 1933. So about 70 years later, and we recently just had our 90-year anniversary. All right, we're going to discuss what's the difference between public official and fidelity. We discussed that a public official bond is a fidelity guarantee that guarantees honesty and faithful performance. However, it is different than a fidelity bond. They're different products. In this table, we'll outline some of those differences. So a public official bond guarantees honesty and faithful performance. It protects the public, you and I. While a fidelity bond is coverage for dishonest acts committed by employees, it protects the employer. Public officials are sworn under oath with the obligee. This is a legal promise to carry out their duties. While on the fidelity bond, the employee has implied agreement of honesty with the employer obligee. Public officials have contractual relationship with the surety company via application and indemnity agreement, whereas on fidelity bonds, there's no contractual relationship with the surety. There are three broad types of public official bonds, or public officials. So we have our first category is administrative duties public officials. These are officials that are, your commissioners, your assessors, judges, school administrators, state boards or coroners, more paper handling type of public officials. The second category is your public officials that handle public funds. And those are your town, city, county, school, and state treasurers, your tax collectors, your court clerks. And our third category is those officials that have direct involvement with the public. Those are sheriffs and sheriff's deputies, also notary publics. For underwriting purposes on the surety side, we generally break these categories and kind of simplify a little bit more into public officials that handle money and those that do not. All right, so what do the public official bonds guarantee for each type of public official? For those officials that are administrative, again, commissioners, assessors, judges, sureties can incur losses on these bonds when the officials make mistakes, they're neglectful, they exceed the authority granted, or handle money when the bond is classed as a non-money handling official bond. For officials that handle public official bonds, again, your treasurers and tax collectors, sureties can incur losses on bonds when the principals handle their duties carelessly or negligently, make unlawful expenditures, or fail to collect required taxes, or when subordinates in their office cause loss through similar actions. All right, our last category is the public officials that handle or have direct involvement with the public. Sureties guarantee payment of third-party damages when principals breach their authority or commit wrongful acts, such as making wrongful arrests, seizing the wrong goods, or failing to seize goods that should have been seized. Notary publics are typically more freely written and there's really low losses, but other categories in this category are a little bit more hazardous. All right, so there are three types of public official bonds. We have individual bonds, schedule bonds, which can be name or position schedule, and then we have blanket bonds, which can be blanket Form O or position Form P, and we'll go over each one of these. Here is an example of an individual bond. It's just, as the name implies, one bond for one person. These are usually dictated by the ordinance as to who needs to be bonded and what the bond amount is. Typically, we see these for money-handling public officials. Most likely, we'll underwrite with an application, obtain identity of the public official. In the eyes of the surety company, we like individual bonds as the liability is limited to the individual, that official title, their duties, and that bond limit. Again, we underwrite and we have contractual indemnity for individual bonds. All right, this next type of bond is a name or position schedule. So this is one bond for multiple individuals or positions, each with their own bond amount. We can name the individual and or the position. The name schedule lists the name of the individual, the position title, and the bond amount. Name scheduled bonds are better for the surety because we can generally get personal indemnity. But there is more paperwork for the obligee as they need to continuously update the schedule as individuals enter or leave that position. It's better for the surety, but not necessarily for the obligee. Name schedule bonds, position schedule lists only the position and the bond amounts, not the individual names. This is less paperwork for the obligee, but the surety is exposed because typically there's no individual indemnity available in the event of a claim. Right, our third type of bond form is a blanket bond. This is an example on the screen of an SFAA form, which is the Surety and Fidelity Association of America. It's just an association that offers standard bond forms to insurance and surety companies. So the blanket bond has two types of coverages. It's the either or. We have Form O is blanket coverage. It's one bond amount to cover all officials or public employees. An example is a $100,000 limit. That is $100,000 regardless of what position or positions caused a loss. That bond amount is kept. For Form P blanket position, the bond amount is to cover each employee in each position. So a $100,000 limit could be substantially higher liability for the surety if several officials colluded in a loss. This form is more risky for surety since liability isn't necessarily capped. On the blanket bond, there are two different riders that can be added. You can add either faithful performance and an excess. Some surety companies only offer faithful performance. Only offer dishonesty. Sorry about that. So basically, if we do not have a faithful performance rider, it's only going to cover that one thing. So just keep that in mind. You generally want to have dishonesty and faithful performance coverage. The excess rider is for an individual position on a blanket bond to cover in excess of the bond amount. So for example, the blanket bond limit is $100,000, but they want the treasurer at $250,000. That's where this fighter comes in. Now, there are two different loss provisions. There is a difference between discovery and loss sustained. For discovery, the loss could have occurred prior to the bond being enforced. The loss occurred before the bond term but was not uncovered during that term. The discovery provision allows the current surety to cover the loss. With loss sustained coverage, the loss must have occurred in that bond period. The surety will only cover losses that occurred during the bond term, not necessarily discovered during that term. So it's just important to understand if prior bonding was in place and on what form when offering discovery or loss sustained, so it's clear on what surety must pay out on that claim. All right, and there's also a couple of exclusions on the SFAA blanket bond forms. Basically, all tax collectors and treasurers are excluded on the form. Often they're required by law to be bonded separately. If not, they can be added by excess rider. That's where that rider kicks in. All right, I'm going to go ahead and turn you over to Nick to an underwriting a public official bond.
Thank you. So as Robin mentioned, public official bonds are, obviously, they're required by obligees who are generally cities, counties, or other government entities. Like most commercial bonds, these bonds are set by statutes, ordinances, or rules set forth by the local governments, and they can vary in bond amount and ultimately underwriting requirements. What makes public official business unique is the requirements and obligations of the bond on a larger level. So what will matter most with public official bonds is the position and the duties of the applicant. Are these applicants handling money or are they not handling money? What controls are in place? Are some of these controls like loss prevention signatures or counter signatures? Do they require signatures on checks? Are there going to be regular audits made on the applicant and what they're doing? How many subordinates do they have? Are the subordinates meant to be covered under the public official bonds? Then there are other details, such as how long are these applicants going to be in office? Are they elected officials or are they appointed officials? Has this applicant ever held public office before? If they have, what was their position? Did any losses occur? And then naturally, the last important piece of things we look for from an underwriting process and in regards to control is what indemnity is or isn't available. Now, on the next slide here, you will see our application. However, it's a bit shortened this time around. So a good practice with public official is probably trying to secure the indemnity is always a good idea. Again, some of these amounts can be relatively low, so indemnity or indemnity signatures may not be necessary, but it is still a good practice to secure it, especially when you're trying to work with an office and things of that nature. Now, as you can see on the slide here, down towards the bottom of the application, there's a section for public official bonds. As I mentioned earlier in the presentation, that section would be on the second page of the application. We're just showing you a snippet of it. That section would include sections that you can fill out information, such as the date of an applicant's appointment to office, or if they were elected, the term of their office, other kinds of controls that are in place, such as are they being audited or not. These are good tools that are on our application that are available to you as the agents to use at your discretion. Now, on this next slide, we will get into the additional and actual underwriting process for public official bonds. So again, depending on the nature of the work they're doing and the size of the bond will play factors in how we underwrite. Perhaps we're dealing with a small $10,000 assistant or secretary bond for a public official. Something like that could probably be done as instant issue. Or we could be dealing with something a little more complex, like a county treasurer who's responsible for handling money, and they could be needing a six-figure bond in this situation. Not uncommon. In that situation, we would probably require much more underwriting requirements, such as potentially running credit or securing financials. And then again, as I mentioned, with public official bonds, beside the initial underwriting classes, we will look into this applicant a little more. Are they a public entity or not? What's their history with this type of work? Things of that nature. Now, I understand that this can all sound like it's a lot harder work to do, but given the public nature of public official bonds and things of that nature, and that we're dealing with more unique government type of entities, we're tending to be a little more cautious or a little more thorough, particular in our underwriting process for these. Now, I will show you on this slide here is a helpful tool that you can all use. This is a tool that is specific to a number of states, and we have a few of them listed here today. These are links that lead to audit reports for cities or counties in a state. Now, by using any of the links here for these states, you can get an idea of where a city or county, or even a state, stand in regards from a financial standpoint. This would be really helpful for the underwriter and possibly you as well, given a public official's position. Let's say they've been made a county treasurer for, say, Tarrant County in Texas. You could use this link to find the state, find Tarrant County, see some audit reports, and get an understanding of what this county treasurer is possibly going to have to do at a certain level. Now, we can look a little more in-depth on this as well. We decided to show, in this example on this slide, you will see the state of Missouri audit reports. Now, the link here, as you can see, is specific to Missouri. And this link will not only just give you audit reports. Sometimes they are more in-depth that look at cities, counties, school districts, and much else in the state. It can give you updates, not just in audit reports, but it can also give you updates to local legislation that has been passed or bills and things of that nature that are being proposed or that have already been passed. These are items that can affect not only what this public official is going to be working on while they are appointed, but it could play a role in what could change to the bond, what could happen. Things of that nature are good to use. These are very helpful tools that everyone will have access to. And as we mentioned, this presentation is recorded and will be shared with you all after today. So you will have access to these specific links. And if you ever have questions, you can always feel free to reach out to an underwriter. We use these in our states as well. Now, the cancellation process for public official bonds can be a little unique. Typically, there are no cancellation clauses on individual bonds. These bonds are written for a term of office. So let's say we've got a public official who's on a 4-year term. We're basically on the bond until that point, unless they are removed from office. And honestly, if they are being removed from office, it may be a sign that there could be some potential issues going on, so we may ask and may look into things. But also to note that while we are on these bonds for these terms, sure, some of you are asking what happens if they get a request to increase the size of the bond during the term of the bond. Most sureties are just going to approve that, and merchants would be similar, but depending on the nature of the increase and what's going on, we could ask questions as to why, and we may or may not require additional information, like maybe we wrote this freely, now we're going to need financials or a credit check to verify this applicant qualifies for a bond of this size. Depends on the request itself. The cancellation of public official bonds are unique. More often than not, we would just get notifications from the obligee or the applicants themselves letting us know that they're retiring or they're not renewing their bond or they did not win their reelection, so the bond is no longer needed. But canceling just because someone asks you to or someone cannot pay for the bond doesn't work. So now we're going to cover some examples here, and I will turn this over to Robin to start us off.
All right, thank you, Nick. Okay, so we're going to go over an example. The first example, and the first step is to review the application. So we have an application for a $270,000 public official bond for clerk treasurer, so they handle money. The clerk treasurer was elected. They were not appointed by the public, but they're elected. They're elected, so they are appointed by the public. Sorry for that. They've been in the position for 6 years, but the bond was non-renewed by another surety company. The application indicates there was a personal bankruptcy in 2011, so it's 2025. This bankruptcy was 14 years ago, so it's not an automatic decline at this point because they had plenty of time to better their financial situation. The application shows that the clerk treasurer handles small $200 amounts, and there's no more than $15,000 a year. So you may want to question, they have small dollar amounts. Why is the bond amount required for $270,000? On the application, it indicates that no counter signatures on checks are required. So this clerk treasurer is free to sign checks as needed. Generally, surety companies like counter signatures, especially if there's a set dollar amount, maybe like over $1,000. Another official has to sign off on that check too. That's a positive control, internal control. The application indicates that the office has been audited by the state every 2 years, and when you review that audit, which is public information that you can pull online, just like Nick had showed you, and there's no recommendations or discrepancies when you review that information, so that's a positive as well. So we've reviewed the application, and the next step is to pull personal credit. The applicant has $4,000 past due on her mortgage, and she has a low credit score of 500. So at this point, we're going to take a quick poll that's not required for credit just to see if you would approve or decline this applicant. So just take a moment here and put yes or no on the poll that pops up. Perfect. We'll go ahead and close that poll. Majority of you said no, and I agree with you because if she cannot handle her personal finances, it's going to be really hard for her to handle a public offices, right? So we're going to do the same here, and this is another application summary. We have a school corporation with a position schedule bond, so one bond that lists all positions. We have positions of a school treasurer for $15,000, cafeteria manager for $5,000, extracurricular activities organizer for $5,000, school secretary for $5,000, athletic director for $5,000, with a total bond amount for $35,000. So all of these positions are hired employees, which means they were interviewed and probably a background check by the school system, so that's a plus. And then the treasurer did allow us to pull credit, and she had clean credit, so another positive. And then we also notice on the application that checks are countersigned. The treasurer is not the only one that can sign checks. Somebody else has to sign them with her. So again, we're going to take a poll. It's not required, just to see if you would approve or decline this application. And go ahead and answer yes or no if we're here for a moment. All right, thank you. We can close it. It looks like the majority of you had said yes. So I agree with you. I think that was a pretty easy yes there. Everything was pretty clean. Okay, this next slide is a claims example. So this is an article that I found online. It's public information. Just have to Google the individual's name, and again, you can get adverse information or you can get positive information. In this instance, this is actually a claim that Merchants Bonding had. And again, this is just an article that was online. So this next slide will have a little bit of a summary of what was going on. It's a $10,000 public official bond for an appraisal clerk to faithfully perform duties in office. The bond was originally issued in 2015 with a new renewal bond issued every year. The bond form had an aggregate clause so that the bond amount would not accumulate with each renewal bond. The obligee on the bond was Fishers County, and they alleged that the clerk misappropriated county funds. The principal was then charged, which is a public official, and indicted by the grand jury. The clerk was ordered to pay the obligee almost $168,000. Merchants remitted the $10,000 bond penalty to the county. The clerk will then need to reimburse merchants the $10,000 and pay the county the remaining balance of the restitution order. So with her indemnity, it's required to pay the bond penalty back to the surety company. Just a heads up, since somebody had asked a question about indemnity. Okay, so there's our claims example. Now, how do we market for public official bonds? A simple way is to volunteer with your local political campaigns. Just get to know your local public officials and get involved. That's always good to build that relationship and get the business. You can also call public official offices to offer insurance services. So just your cold calling, give them a call to see if they are looking for another carrier. And I think the most important way to get public official bonds is just to review your book of business. Does your agency offer insurance to schools, hospitals, municipalities, county districts, etc., but not write their public official bonds? We just need to round out that account, get the whole business, build that whole relationship, and go from there. So I think that's a very important route to go if you're looking for this business. So in summary, we discussed in this public official section that public official bonds guarantee faithful performance and honesty, that there are 3 types of public officials, and those are your administrative, funds handling, and those involved with public officials, or the public. We also discussed that the bond is set by statute, ordinance, or rules. The bond amount and the requirement are set. We talked about how we underwrite public officials with a very heavy emphasis on integrity of public official and internal controls. We discussed the bonds that the bond forms are written on, which is your individual bond, your schedule bonds, or your blanket bonds, and also that the bond is non-cancelable. It's generally going to be enforced for the term of office. So that wraps up our discussion on license and permit and public official. So this course is technically over. I want to let you know, if you refresh your screen, you can there'll be a link to download this PowerPoint, so that way you can have that for your reference. And, we only have a couple of minutes to answer questions, and there's some questions in the chat box. Those that want to leave, you can go ahead and leave. You've met your requirement. And those who want to stick around for about 2 minutes, we'll answer what we can in this amount of time. And then at a later point, we're going to try to compile these questions and get back to you individually. Thank you so much for joining us today. And I hope you learned a little bit more about license and permit and public official bonds. Thank you.